Hello and welcome to episode 2 of season 2 of Seed Stage. My name's Christopher Goodfellow and I'm the program manager at The Pitch. We've just gone live with applications on The Pitch, so if you are looking to meet investors, to get support and coaching, do have a look at the website and apply. We'll include the link in the comments. We wanted to do something looking at the different things you need to get in place to raise seed stage investment for your startup. We brought on an expert and serial investor, Sam Simpson, who's going to walk us through the 5 basic things you need to get ready for your investment round, and go into a little nuance from the investor's perspective. So what are they looking for in your deck? How do they think about your valuation and so on? So it'd be lovely, Sam, if you could just introduce us to yourself and your work.
Yeah, thanks for having me, Chris. Really great to be here and lovely to see another year of The Pitch. I'm looking forward to every year. I'm a judge at the Bristol finals, so really looking forward to seeing you and the team in person there and seeing some great, 1-minute pitches again. So by way of intro, I'm Sam Simpson. I'm CEO and co-founder at Founder Catalyst. We do a few things. So we help people get ready for funding rounds, so help them get SEIS, EIS, advanced assurance in place, do their legals and introduce them to investors. I guess broader, I'm an investor myself, so I've got 32 investments over the last 6.5 years, and I'm an exited founder as well. So I've been your side of the fence, in the trenches as a founder. I grew a company from 0 to 30 million in 4 years, then exited to private equity, which was as much fun as it sounds.
Yeah, awesome intro, Sam, and I really appreciate the extent of your advice, both making investments in startups and, like you say, you've been there as an entrepreneur, done it yourself, and done the hard slog, so really appreciate that. And I should say, so Founder Catalyst are a partner of The Pitch. They have been for a couple of years now, and I really appreciate that support. We're actually running a competition with Sam at the moment, so if you do want someone to look at your investment deck to give you a review, you can submit that on the website, and Sam picks some to look at every couple of weeks and give like a full breakdown of how an investor would evaluate the deck and therefore what you can do to improve it. So if you do want help on that front, have a look. We've also got an offer with Founder Catalyst. So if you want reduced priced SEIS insurance and other fundraising legals, we can help you with that too. So let's get into it then, Sam. So the first point we wanted to look at is the pitch deck. So just give us the context of what that's used for, and then we'll go into kind of how an investor would look at it.
Yeah, for sure. So pitch deck is probably is absolutely actually the most important of these 5 aspects you need to look at. There's typically 2 types of pitch decks. You'll usually have a read-through deck that you email to your investors, and they sit there, in the evening flicking through, and that needs to have enough detail so that it doesn't need your voice adding narrative to it. So it needs to be standalone. It's usually more wordy than the other type of pitch deck that we'll come to in a second, but and it's just standalone. So that's useful. You then get a kind of walkthrough pitch deck where you're there talking people through. You want less words because actually you don't want people reading your slides. You want people listening to you. You want people to understand your passion and they're buying into you as a founder. So usually two nuanced pitch decks, but based upon virtually identical content. Pitch decks have, and I don't know whether this is a good thing or a bad thing, but pitch decks have a ridiculously formulaic structure. There is a standard flow, and I can put my investor hat on for a minute. If anybody deviates from this flow even a bit, then it's actually really quite annoying because I want, great, I want to know what the problem is. I want to know what the solution is. I want to know why now. I want to understand what the market size is, what the competition is. I want to understand, who the team are. Then I want to understand your ask. So it's a really formulaic flow. And if you kind of jumble that around or you miss anything out, I'm like, well, that's, it just causes me a problem reviewing your opportunity, which is even subconsciously a little bit annoying. So, do follow that standard flow. Obviously, play to your strengths. If you've got ridiculous levels of IP, you've got a patent and a PhD in a subject, I want to see that emblazoned all over, the first couple of slides. If you've got multi-exited founders, then you really need to double down on that. So I think, you've got to play to the strengths in your opportunity. Maybe now's the time. If I can pop up a very quick diagram, and I know we're going to share lots of links after with the show notes, but this is hopefully a really useful diagram which shows from an investor point of view how I would evaluate a startup. Now, this diagram is particular to me. This is my brain dump built around, like I say, 32 investments and seeing thousands of investment opportunities a year. But this is kind of how I evaluate a startup. And virtually every investor will have something similar in their own mind, although everybody will have different priorities. Like, some people will care about the proposition much more than they'll care about team, and some people will go straight to the forecast, and some people care about what deals are offer. They'll kind of be fussed by that. Personally, and I'll glimpse into my psyche, the first three things I look at in a pitch deck and in all your materials actually is team, team, and team. If you've got a really great, credible team, multiple exits, if I like you as a person and you pass the do I want to have a beer with this person test, have you got a broad team with all the capabilities your business needs, or at least a roadmap to get there? Do I love your attitude and passion? Do I can see you've got fire in your belly, and those inevitable knockback from investors aren't going to deter you from your path? If all of those things are true, then that's a really, really, really great starting point. If you're missing any of those, and you can kind of look at yourself and see if you're missing them, then you need to work out how to address that, because without a great team, I think most investors will walk away. And that's because, God, why is that? That is because as an investor, I know you're not going to have a perfect idea to start. You are going to need to look at your idea over time and potentially pivot. There's a thing in all startups where they go, oh, this isn't quite right, we're going to pivot to something else. And that's absolutely fine. If you've got a great team, you'll identify that things aren't 100% right, and you will understand, you'll work out in a systematic way the best pivot that is good for your business. If you've got a substandard team, or maybe a team of one, which isn't ideal for most investors for lots of reasons, you just may not be able to find that pivot. Either you won't identify you need it, you'll be stubbornly sticking to your plan A, or you just won't find a pivot that's credible. So team is absolutely, for me, the most important thing. Sorry, down a rabbit hole on team, but it is, these elements here cut across all of your documents. You've got to, all five things we're going to talk about today fit like hands in a glove. Yeah. And the same themes that are on this slide apply across all of those documents in slightly different ways.
And so of those sort of 30 plus investments that you've made as an investor, how many of those relationships do you think started with you seeing a deck and then arranging a meeting after that?
Yeah, lots of them. So back pre-COVID, if you can remember those times, some of my investments were made. I met people physically at pitch events, and my first investment ever, I saw just an amazing, charismatic founder on stage who, just had the way she spoke with complete confidence. She brought humor to her pitch, and she was just the perfect founder from my point of view. Virtually everything these days, though, it starts with the pitch deck, and everything opens up there. So one of two things happen: either I have a meeting with somebody, and inevitably they end up walking through their pitch deck, or I'm sent a pitch deck out the blue and I review that. The other documents follow and they support the narrative in the presentation in the pitch deck, but the pitch deck's by far the most important up front.
Excellent. So let's take it on to forecast then. So we're talking here about sort of pre-revenue or early revenue startups that are seeking seed investment. So there's not a huge amount of sort of fundamentals to go on when you're putting together a forecast. So first of all, it would be good to know, as an investor, what are you looking for at that stage?
Yeah, forecast is one of the trickiest things for founders to get right, and actually it's one of the trickiest things for investors to analyze, because there's no data points to validate. I can't, if you're already at 10,000 a month revenue, then you can reasonably predict based upon previous growth how your growth is going to work, and you'll fold in the inevitable hockey stick and da 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 da. If you're pre-seed, pre-revenue, then none of those data points exist, and actually it's hard for you to forecast, and it's hard for investors to validate. I'll let you into a secret for an investor's point of view. Every investor knows that every forecast is wrong. That is absolutely true. It's, ideally, it's going to be pessimistic and you'll blast through the targets. More realistic is that, you will be overly optimistic with your, when revenue is going to occur, with the amount of revenue. You'll underplay your costs and, standard business stuff where everybody has optimism bias. on that basis, every investor thinks the forecast is going to be a bit nonsense. So actually, they're validating your thought process that got to the forecast. So they will be looking at, firstly, is it a well-constructed forecast? Do you know your way around Excel? Can you write formulas sensibly? And do you know how to format a spreadsheet? Those are the basics. If you don't know how to do that, find somebody who can support you with the forecast. Secondly, an investor wants to understand the assumptions that underpin your forecast. So they want to see, maybe a variables tab or an assumptions tab where you say, our customer acquisition cost will be X. The lifetime value is going to be Y. This is how, this is the percentage growth we can expect per year. This is, if you've got a SaaS platform, they will want to understand the attrition rate, for example, that's modeled into your assumptions. And they will want to see something that's layered from, the assumptions around customer acquisition, how that turns into revenue in terms of timing and things like that, which costs of sales are associated to each of your sales and each of your revenue lines, what your overheads are, so team size, how does that grow over time, how much do you spend on marketing, all of that kind of stuff. Finally, they want to see that modeled with, an EBIT and then a cash flow forecast under that. So it's kind of just walking through that very, very standard model. And at Founder Catalyst, we offer a minimum viable product forecast that's perfect for HMRC, SEIS, EIS purposes, but is also a good generic starting point to building a forecast model for your investors too.
Excellent. And you mentioned there that, a great point about sort of validating the founder's ability to do this kind of thing, right? That maybe their forecast won't be spot on, or probably it won't be spot on, but it just shows that they know how to use Excel, how to think about their business, and they've considered everything. On that front, are there any red flags when you kind of see a deck and a forecast in a deck where you're like, okay, that's definitely an issue?
Yeah, and I don't judge it. Let's go back to pitch decks for a second. I try not to judge people by the look and feel of their deck, but it's inevitable. If you've got something that's, my 4-year-old daughter could have drawn with crayons, with spelling mistakes and, it's not looking polished, you kind of think, well, if that's the pitch deck, that is the most polished document that founder is ever going to produce in their life. What else sits behind it? And it just sends the wrong message. And I try switching off to that stuff, but it's impossible. So every investor will be judging you by the content and the look and feel and how you present it and the narrative and every aspect of that needs to be polished. Forecasts, overly aggressive, if you say you're going to get to 100 million in 3 years, then, everybody's just going to close the forecast and walk away because they know it's unrealistic. So there is a balance here. What you don't want is a forecast that is completely pessimistic. If you're still loss making in year 6, then as an investor, I'll be like, why am I putting money into this business again? But similarly, if you're like, yeah, we're gonna be billionaires in year 3 and we're gonna own a yacht, I'm not going to believe that either. One failure I often see in forecasts, just to come back to that, is a founder will have a really great idea, but they need to do 2 years of R&D and development to get to even launch a product. And you'll see the founder draws a line and finishes the forecast model in year 3, where the business is still loss making. I'll be like, well, that's absolutely uncompelling for every investor out there. If your forecast, and there's nothing wrong with having a long R&D period. Sometimes it's life in some deep tech businesses, but I want to see a forecast going out to 5 or even 7 years. So I know there is light at the end of the tunnel from that, spend up front. If you can't bring that to life, then that's a problem. And I see that quite often, the kind of forecast that stops in a loss-making business.
Yeah, you've got to sell that opportunity.
Yeah, exactly.
Yeah. Okay. So let's go on to SEIS. I think most people listening to this will have an idea, or at least have heard the term if they haven't already got advanced assurance. But just give us that context first of all of what it means and what it does.
Yeah, for sure. What I'll do is share a diagram, and again, we've got this. We can share this on our site. But this is a really lovely way of displaying the benefits of SEIS EIS. Let me do a 1-minute sheet dip into what these are. SEIS and EIS are tax relief schemes from the UK government. SEIS is Seed Enterprise Investment Scheme, and EIS is Enterprise Investment Scheme. SEIS is the little brother, if you like. It's used for very early stage businesses, first 3 years from the date you start to trade, and you can only raise 250k. You then move on to the big sister, if you like, EIS. That allows you to raise much more over a much longer period. You can use both in conjunction with each other. So if you're raising £500,000, you'll use the first 250 will always be under SEIS, and then the next 250 under EIS. Why are there two schemes? SEIS is meant for maximum risk businesses. So early stage, there's a very high chance the business will fail, and therefore the investor gets really, really great tax relief. EIS is for later stage businesses where they're deemed to be less risk by the government. Let me give you a really quick example of the tax benefits for me as an investor. Imagine I put £10,000 into your business under SEIS. The government will give me back almost instantly half of my money. So I get £5,000 in my bank as a tax relief almost immediately, which is amazing in isolation. That would do nicely, but it doesn't stop there. If you turn my £10,000 investment into £1 million after 3 years, so 100 times return on my money, which for the avoidance of doubt is a really beautiful thing, then there's no capital gains tax. There's no tax at all to pay on that increase in value. So when you exit and I get my £1 million in the bank, I haven't paid a penny in tax on that, which is genuinely amazing. There's also loss relief. So if I invest in your business and your business fails for whatever reason, then the government will give me back roughly another 22% of my money. So actually, I'm just risking £2,800 out of every £10,000 I invest. Final benefit is inheritance tax relief, whereby if I own shares in your business for at least 2 years and then I die, those shares will pass to my estate outside of the inheritance tax calculation, saving potentially 40%. That last one's not so cheery, but if you're slightly older like me and you're worried about your inheritance tax position, actually it's a really nice way of offsetting that tax. Sorry, you're going to ask a question, Chris.
Absolutely. So yeah, it's a really aggressive scheme, world leading, and obviously the idea here is that we're encouraging people to put money into risky assets effectively, so to back startups and giving them some support to do that, which is amazing. When you said there income tax relief, do you want to sort of explain that point about the kind of individuals that can access that? Because obviously you need to have a big enough income tax bill to be able to offset it, I assume.
Yeah, I mean, anybody that pays income tax in the UK can make use of this scheme. And if you do crowdfunding via, say, Seedrs or Crowdkey, for example, you're using exactly the same scheme, and but you're getting hundreds of investors at a time rather than just one or two. So anybody with that pays any income tax at all in the UK can make use of this scheme. It doesn't differentiate. It's worth mentioning that foreign investors can't make use of SEIS EIS. And VCs and other institutions can't either. So it's just aimed at angels within the UK. Let me give a quick worked example of EIS as well, and then we can dive into the next topic. So EIS is the big sister, as we said. You can raise up to 12 million, maximum of 5 million a year over 7 years, but the tax relief are slightly less. If I put 10 grand into your business via EIS, then I get £3,000 back. So rather than £5,000, I get £3,000 back. I get the same capital gains tax and inheritance tax exemptions, and the loss relief is proportionally less as well. So I'm risking more of my money, but the theory being there's less risk because it's a later stage business. So just both amazing schemes, and like you say, world leading. There's no other country that offers anything as generous as this.
Excellent. What does that mean for founders?
So these tax relief, you'd have probably spotted, these tax relief are for investors rather than founders. So founders might be shrugging, going, why do I care? Two really good reasons you care. So SEIS and EIS are your superpower. If you are raising in the UK and you're not offering these tax relief schemes, angels will not even look at your opportunity in the vast majority of cases. I've got 32 investments myself. Every single one's under SEIS EIS. If people approach me and they don't have advance assurance in place, and we can briefly cover that in a second, I don't even look at the opportunity because I know people aren't intentional about fundraising. So point one is it is table stakes. If you're not offering this, and there are thousands, literally thousands of opportunities that are, then people generally won't be investing in your business, which is bad. The second benefit is slightly softer, and there are loads of rules around SEIS EIS. I won't bore everybody on 40-minute talk right now. One of the rules is around the rights and protections that I'm allowed as an investor in your business. And I'm not allowed things like liquidation preferences and anti-dilution and non-diluting shares. Those things are not compatible with the SEIS and EIS scheme. Now, you may not know what those things are, but they're very, very, very founder unfriendly. So they're in my interest as an investor, therefore not in your interest as a founder. Now, under the SEIS and EI scheme, I'm not allowed any of those things. So as an investor, I get the choice. Do I want these absolutely amazing tax reliefs, or do I want these VC type punchy, rights and protections? And actually, every investor, every angel investor selects the tax relief. So as an aside, it gives you really, really founder-friendly terms compared with non-SEIS, EIS investments. So those are the two benefits for founders specifically.
I love that. The government's basically saying we're going to give you a huge tax break, but we're going to make it fairer for the founders.
Yeah, exactly. We don't want you to de-risk in any other way, which is essentially what those other items are doing. So yeah, that's it. I mentioned, just to come back to one point that I mentioned, very briefly mentioned advance assurance there. Advance assurance is really critical. That's the thing that you need to prepare before you go to speak to investors. Advance assurance is your only way of proving to investors that your company should be benefiting from these. Investors will benefit when they invest in your business. So advance assurance sounds grand, and it's just an email from HMRC that says, on the basis of everything you've told us, Mr. Founder, your investors should benefit from these tax relief schemes. It's essential when you're speaking to investors, and it's one of the services that we do for free when founders commit to a funding round with Founder Catalyst.
And again, we will include the link below in the show notes. So we've gone through the kind of this in rough chronological order. So hopefully at this point, people are talking to investors and perhaps getting their first term sheet. So give us the context of when that tends to come into play and what that's going to achieve.
Yeah. So in later stage business, in later stage funding rounds, the investor will typically give the founders a term sheet. So if you speak to any VC, they'll have and it will be spiky, by the way, it will be very, very founder unfriendly, but they will produce a term sheet and, you can negotiate on that. In an early stage funding round, it's the founder that is responsible for producing the legal paperwork. And again, that's what we do as a platform. And the term sheet is part of that. So what is a term sheet? Well, let's take a step back. What does a funding round set of legal documents look like? Usually there's about a dozen different document types. Depending how many founders and investors, you could have 60 documents flying around. And some of those documents are really big. The shareholder agreement, the articles, they're 40 or 50 pages each. Nobody wants to read that when they're starting a negotiation between founder and investor. So the term sheet distills all of that detail down into a 4 or 5 page document, and it summarizes the key points of the deal. So as an investor, what do I want to know? Well, I want to know what legal entity will I be investing in? Who are the statutory directors of that? What does the current cap table look like? What valuation are you raising at? So the economics of the deal, and what legal rights and protections am I as an investor getting in your business? So am I getting drag and tag? Am I getting information rights? Are you giving me investor consent? Which of those kind of legal protections are you offering me? And it's the starting point for those legal negotiations. There's also a really nice soft benefit for a founder. The term sheet, when a founder and investor signs a term sheet, it's not really legally binding other than confidentiality. But it's part of the momentum of going from initial conversations closing a round. If I'm an investor looking to invest in your business, I'm not going to sign a term sheet unless I'm really genuinely interested in it. So it's a nice way of getting people off the fence. Now, just because an investor signs a term sheet doesn't mean that they are obliged to invest, and it doesn't mean as a founder you're obliged to accept the investment, but it's a really nice nudge along that journey towards getting cash in the bank.
Absolutely. And I think just that momentum point as well, once you've got a term sheet, presumably you can then talk to other investors and mention it and try and get the snowball effect.
Exactly that.
Excellent. And then are there any key points, appreciate we're short on time, but are there any key points you'd sort of stress to look out for when you're putting that term sheet together?
I mean, you won't be surprised to hear that we've got an article on term sheets and, normal angel investors, if they're investing alone, their term sheets are usually reasonable. If you are looking to take money from, angel groups and private equity clubs, broadly, they're okay as well. And then actually the crowdfunders are pretty reasonable. You've got to be careful. As you get to more professional investors, the term sheets will start getting more punchy. Again, let me very, very briefly share a diagram. I'm not going to talk through this because we could be here for yet another hour. But I will share this very briefly. And we've got a very detailed article walking through the anatomy of a term sheet and we've got a phrase for it, what a toxic term sheet looks like. So you get some term sheets that are completely benign. You get some that are really, really, really punchy, very, very, very investor friendly. And you can see here, we've broken this diagram down into the things I mentioned earlier. What are the deal economics? How's the deal structured? What share classes? You've got some ridiculously standardized things here, things you see in every single term sheet. You've got some stuff that's, roughly 50-50 on this stuff, whereby sometimes you see it, sometimes you don't, depending on how sophisticated your investors are. And then you get the really, really punchy non-SEIS, SEIS compatible stuff. We've got an article which deep dives into all of these elements here and points out what you should be kind of worried about and not.
Excellent. And as before, all this will be in the show notes so that you can deep dive on that by looking at Sam's article after the episode. So let's go on to our final point of 5 then, valuation. So we're looking at that seed stage investment. So what are the two main ways that you would kind of set out or create your valuation for your startup?
Yeah, and in theory, valuation should be, it feels like the easiest thing out of this list of 5, doesn't it? It's a number. What is your valuation? Well, it's 1.5 million pre-money. That sounds like it should be the easiest thing, but actually it's often the most emotional thing, both from a founder and an investor point of view. Why does it matter? Well, the lower your valuation, the more you're going to dilute for any set amount of investment. So from a founder point of view, you want your valuation to be as high as possible with some caveats. From an investor point of view, you want to get maximum bang for buck or maximum shares per your investment. So you've got the opposite requirement there. You want to kind of drive down the valuation within reason. When you're a later stage business, there are lots of standard ways of valuing your business. When I exited my business, which had revenue and even EBIT, we were at 3 million EBIT. Well, it was straightforward. You negotiate a little bit on the EBIT. There are add backs and take away, but the EBIT pretty much is what the EBIT is. And then you're just debating what the multiple is. And in our case, it ended up at a 10 times multiple. So our business was worth 3 times 10, 30 million. That was it. You can debate both those points, but it's a relatively straightforward conversation. When you are an early stage business and you're pre-seed and pre-revenue, actually, it's really, really hard. You don't have anything to multiply by. You can't have a revenue or an EBIT multiple because it just makes no sense. So there's a couple of ways that this is arrived at. Again, we've got an article just on valuing a pre-seed, pre-revenue business that we'll share in the show notes. The normal way of doing this is to look at what normal looks like. So are there comparable transactions in the market that you can find? If you're making jam in your shed and somebody else who made jam in their shed got valued at 900k, pre-seed, pre-revenue, well, great. Use that exactly that as a basis. Maybe your business is a bit more attractive from an investor point of view. Maybe it's less attractive, and you can kind of adjust by 100 grand here or there. For me, the best place to go. So Bowhurst, there's a company called Bowhurst who track every funding round in the UK, and they have really great statistics on what does normal look like. And their last statistic says that for an average pre-seed, pre-revenue business, the average valuation, pre-money valuation is 1.5 million. And by the way, the average raise amount is now £250,000, which is exactly the SEIS limit. So everybody's kind of lifted themselves up to that. And as an investor, just as a tip, whenever I see a business and it's pre-seed, pre-revenue, if it's much more or much less than 1.5 million, I start asking lots of questions. You see people going, our pre-money valuation is going to be £4 million for our pre-seed, pre-revenue business. And you kind of say, well, where did you arrive at that? And they're like, oh, we've got a brilliant forecast and we know we're going to be a 100 million business in 4 years, at which point you go, yeah, okay. That is not a reasonable way of looking at it. There are more formal ways of doing this. There's a method called Berkus and there's a scorecard method as well, which are two relevant for pre-seed, pre-revenue. But essentially, they all follow the same kind of approach, which is look at what normal looks like and adjust the valuation either down for certain elements or up. So to give you an example, I'll start at 1.5 million for any business. If they've got IP, if they've got a multi-exited founding team, if they've got patents, if they've got a founder with a PhD, if they've built their product and it's nearly ready to launch, if they've got brand partnerships ready to go with, Google or whatever it happens to be, all of those things are really, really, really nudging the and nudging the valuation up, potentially up to 2.5 million, maybe, if all the stars align. Similarly, if a business has, solo founder, they've not developed anything yet, they've got a shiny pitch deck and a bright idea, but have done nothing. If it's not patentable, if there's no IP to speak of, if it's a first time founder, I'll add all these things and say, actually, I think your valuation's 1.2 million or whatever. There is a really useful sanity check that every investor knows that most founders don't. So here's a tip for free as well. Every investor in their mind is going to be working out the percentage dilution in a funding round. And they will be saying, say you're raising 250 at 1.5 million valuation, you'll do the 250 divided by 1.5. If that fits somewhere between 15 and 20% dilution, then the number's there or thereabouts, right? Now, you could still have a ridiculously high raise or whatever, but as long as the number's between 15 and 20%, that's a really useful sanity check. Say you're diluting by 2% in a funding round, that's indicating you're either raising a trivially small amount or your valuation's ridiculously high, or both, could be both. Similarly, if you're diluting by 40% in a funding round, in theory, that sounds great to me as an investor. In practice, it means there's something dramatically wrong.
That's really, really useful to get those benchmarks. And just speak to why, particularly at that kind of seed and pre-seed stage, that people would want to hit that sort of 15 to 20% and the implications as they go on to do other funding rounds.
Yeah, so every funding round you obviously dilute more. So the first funding round you dilute by 15, 20%, and the next, and the next, and the next, and that all adds up. Bad things happen if a founder is diluted too much. And I've got an example. If I can give you a war story from my own investment, and I won't name the business, but I invested in a second funding round. So they're already diluted by 15%. I invested. It's a very regulated industry, so they had a few funding rounds ahead of them. And they came to do a Series A, and they went to America. They found a Series A investor that was going to put £3 million in, I think it was. The investor looked at the cap table and said, well, hang on, at the start of this funding round, the CEO only owned, less than 10% of the business. And the investor is paranoid that won't be material enough for the founder to, if things get hard, the founder's just going to chuck in the keys and go, oh, well, I only own 10%. It's, there's no massive attachment. So before the Series A investor would invest, they recapitalized the founder, or I recapitalized the founder, should I say. So effectively, the founder got free shares in the business to get them back up to 20%. And then the investor invested and they diluted a little bit from there. But that was a really painful funding round because it's effectively double dilution. Firstly, I'm losing shares. Every time the founder shares are going up, my shares have to go down. There's no magical pot of shares that get created. So my shares in the business are going down, even though I invested a few funding rounds ago. And then the Series A investor came in and massively diluted as well. So I got double dip dilution there. And that's the problem with having over diluted founding team.
Excellent. Anything else you want to say on those 5 points before we wrap it up? Just kind of looking back at the whole journey.
No, I think, going back to the diagram we showed at the start, try to get your mind try to get your head in the space of an investor. Try to look at your business as an investor will. Have a look at our diagram, which shows each of the facets, team at the top right that I banged on about extensively, but get your head around each of those points. And for every document you're producing, just try and look at it from an investor lens and knock off any rough edges and address any question points that you think, oh, actually, we're really weak on IP and competition. Well, great. Go and address those in your pitch deck, because otherwise investors will look at your pitch deck and go, what about IP? Where's your defensibility? What's your competition? And if I were a founder presenting, I want to hit those things head on and address them rather than, have an investor pulling at the thread. That's much, much more uncomfortable.
Love it. Really appreciate the run through there, Sam. As we mentioned a few times during the episode, we'll include lots of links below that gets into this stuff in lots more detail. So if you need to do your research, you can look below the video. Just to reiterate, Sam is kindly supporting the pitch this year, and we're running a competition where he will review your pitch deck, break it down for you, and give you lots of advice on how you can improve it and hopefully have a better chance of raising investment. If you're keen to take part, have a look in the show notes and we'll link to that. We're also open for pitch applications now. So if you do want to get your business in front of investors, you can enter now. It takes about 8 minutes to enter, and we're going around the country running regional finals. So everybody that takes part gets to get up on stage and pitch to investors like Sam that are active seed stage investors and are investing in the local area. So it doesn't matter if you're based in Edinburgh, Glasgow, Manchester, wherever. Do have a look at the competition and enter if you're raising seed stage investment right now. And finally, just thanks to everyone for listening. Give us a comment. Let us know what you think. Thank you.